Hey everyone, welcome back to The Explainer. Today, we're unpacking something pretty fascinating, the securities-backed loan. Now, if you've ever wondered how high net worth investors manage to get their hands on massive amounts of cash without actually selling off their prized investments, well, this is the secret sauce. But as we're going to see, accessing that liquidity from your portfolio means making a very specific trade-off. It means handing over the steering wheel. So let's dive right into this and see exactly how this machinery works. Here's our roadmap for today. We're going to break this down piece by piece, starting with the core concept, moving into the math behind LTV, the very real threat of margin calls, the costs and repayment structures, and finally, a strict checklist you absolutely need to review before you borrow. Let's get into it. All right, section 1, the core concept. Ownership versus control. To really grasp how these loans function, we've got to look past the cash itself and focus on this delicate balance. So what exactly is it? At its simplest, a securities-backed loan is a collateralized financing structure. You, the borrower, get a loan or a line of credit by pledging marketable securities from your own investment portfolio as collateral. Your portfolio itself actually becomes the fuel for this financing engine. It's the bedrock that lets you borrow money without triggering a massive sale of your assets. And this right here is the central trade-off. It's the crux of the whole arrangement. On one hand, ownership is retained. You keep your portfolio. But on the flip side, control is heavily restricted. The lender steps in, dictates the boundaries, and usually locks those pledged assets up in a segregated account. Think of it like this. You absolutely still own the car, but the lender is holding onto your keys until that loan is completely settled. So how does this actually play out in the real world? It's basically a four-step journey. First up is the assessment. The lender takes a magnifying glass to your securities, looking hard at liquidity and risk, not just the headline dollar amount. They love highly liquid, publicly traded equities. Next is valuation, where they figure out the absolute maximum they're willing to lend you. Then comes formalization, signing the paperwork, setting the terms, and the lender officially taking control of that segregated account. And finally, disbursement. The cash is released to you, ready to be used, though usually with a few strings attached, like not using it to just buy more stocks in that same account. Moving on to section 2, the mechanics of LTV. This is where we get into the math, because your borrowing capacity isn't just about market value. It's a massive exercise in risk management. When we look at the loan-to-value, or LTV ratio, it's really the throttle of the whole loan. Market value is on the list, sure, but purely as a starting point. Lenders care way more about the next 4 things. Liquidity, how fast can they execute a sale if things go sideways? Volatility, how wild are the price swings? Diversification, is your entire portfolio riding on one risky tech stock? And finally, just general market conditions. They use all of this to figure out how safe their money really is. To put this into perspective, let's look at a pretty common benchmark. If you've got a portfolio of highly liquid, publicly listed stocks, you're usually looking at an LTV of around 50%. So you pledge $1 million in stock, you might get a $500,000 loan. If your assets are clunky to sell or super volatile, that number shrinks incredibly fast, or they might not even lend against them at all. Now here is the real kicker. Once that loan is active, the LTV ratio is monitored continuously. It does not dynamically reset to give you breathing room. You've got a fixed loan amount sitting against a constantly changing market value. Every single day the market moves, your effective LTV shifts right along with it. And that creates a very specific, constant structural danger. Which brings us directly to section 3, the margin call threat, when the pendulum swings. This is the climax of the whole structure and the ultimate stress test for any borrower. I want you to honestly ask yourself this. What actually happens when the market value of your pledged securities takes a nosedive? Your loan amount hasn't changed, right? So a drop in your portfolio's value means your LTV ratio suddenly spikes. And if it crosses the maximum threshold you agreed to in your contract, boom, you trigger the lender's primary control mechanism, the margin call. When that margin call hits, the lender demands immediate action. You've essentially got 2 lifelines here. Lifeline number 1, you provide more collateral. You pledge extra eligible securities to pad the account and fix the ratio. Or, lifeline 2, you pay down part of the loan immediately. Shrink the loan amount, fix the ratio. Simple math, but incredibly stressful in practice. But what if you can't swing either of those lifelines? Well, listen to this harsh reality straight from our source material. Failure to meet a margin call allows the lender to liquidate pledged securities without consent, potentially crystallizing substantial losses for the borrower. Did you catch that? Without your consent. They do not have to ask your permission. They will sell your assets at whatever the current market price is, even at a huge loss, just to protect their own capital. It is a brutal structural reality. All right, let's take a breath and move to Section 4, Costs and Repayment, Structural Realities. Assuming we survive the margin call drama, let's look at the operational reality of actually paying this money back.
Your costs are totally dictated by your interest rate structure. Bank-issued lines generally use variable rate facilities linked to benchmarks, like SOFR. That means your borrowing cost is going to bounce around as market rates change. On the flip side, private stock loans might offer fixed rate structures. You lock in a specific rate for a set term, giving you absolute cost certainty from day one. It's a classic choice between the risk of market movement and the safety of predictability.
When it comes to the actual repayment style, the structure totally dictates your cash flow. If you go with a securities-based line of credit, you're usually just paying interest for a set period, and the big, heavy principal payment is deferred until maturity. But with a term loan, you're making scheduled payments of both principal and interest over time. Regardless of the path, the lender holds the cards. They dictate the payment frequency and any pesky penalties for paying early or late. And that brings us to our final part, Section 5, Before You Borrow, the checklist. For anyone evaluating this kind of financing, you absolutely need a pragmatic approach before signing anything. Straight from the source, here is your essential pre-loan checklist. First, pin down exactly which securities are eligible and what haircuts or value discounts the lender applies. Second, know exactly how they calculate that LTV in practice. Third, read the fine print on the covenants and pricing. Fourth, and this is huge, know your exact margin call triggers and the precise timeline you have to fix them. And finally, stress test your own finances. Could you actually handle a margin call if the market suddenly tanked? Because as we wrap this up, here's the ultimate thesis you need to walk away with. The key variable isn't just about getting access to cash. It's about how this entire financial structure holds up under changing market conditions. Yes, it gives you incredible, fast liquidity, but it absolutely demands total respect for LTV mechanics, margin exposure, and the sheer power of the lender's right to liquidate. So I'll leave you with this to chew on. You know the mechanics now, you know the hidden risks. If severe market volatility strikes tomorrow, could your portfolio and your entire wealth strategy actually withstand the realities of the lender's control? Thanks for hanging out with me for this Explainer Focus, learners. Keep asking the hard questions, and I'll catch you next time.